This video is about chapter 10, which talks about estimating expected returns. So basically, as we've discussed through this entire course, in order to be able to carry out our portfolio analysis, the first thing we need to do is we need to have estimates of expected returns in the future. We need variances or standard deviations. We need covariances. And then once we have all these things put together, we can then estimate a portfolio using those values. Okay, out of all these, the hardest one possibly to estimate is the expected future return. Okay, so we need to figure out why or how we can come up with expected future returns. So if you think about it, uh, how do we value a company's stock or the valuation of the whole market? It's based on expectations of all the participants in the market. If every participant in the market thinks, hey, this asset is going to go up in value, that's going to increase the stock price, and that's going to give us a future return estimate. If everybody in consensus think some asset is going to go down, that'll give us a future expected return that's negative. But what do future returns depend on? It depends on how these expectations change over time. If somebody expects the stock for nothing to happen to it, then the return will be pretty close to zero. However, if more people start suddenly thinking, hey, there's some new information that's going to come out and that's going to increase the stock price, that will give us a future expected return that increases. So these things are unobservable because there are so many diverse opinions in the market, and so there's no real golden rule for how to do this. The only thing we can suggest is the textbook can suggest is different ways to go about it, and so there's some presented in here. Okay, so the first topic is aggregate asset allocation. And what is aggregate asset allocation? It's basically how much you invest and what proportions you're going to invest in broad categories of assets. Okay, so it's basically diversifying not between individual stocks but between different asset classes. So something like how much do I put into large cap stocks? How much percentage do I put in international stocks? The different kinds of bonds, like government bonds, corporate bonds, how much of my assets to put into real estate. Okay, so all pension plans make these sort of asset allocation decisions. Endowment managers as well make these kinds of decisions. So if you think about it from a pension plan's perspective, they'll usually be a plan administrator, and they decide on how their pension plan is going to split their assets into different categories. Okay, they'll hire portfolio managers to select individual securities within those asset allocations, but the actual administrator is making the decision of how to split their assets between these different kinds of classes. So there are a lot of things that go into determining how we get returns for asset categories. But basically, the big three-step procedure is first, you have to come up with the normal return for that asset category. Okay, what do we think the normal return is going to be? Then we need to estimate how much we expect these normal returns to deviate in the next period. For example, if we think the normal return is 10% on the market, and then we find out about the coronavirus situation, we got to make an estimate for how much we expect between this period and the next period, how much we expect the market to shift away from our 10% normal return. Okay, and then we then find out how much. The third step is finding out how much deviation we're going to have for each manager who's choosing to manage that asset category from the average for the entire category. Okay, so if there's multiple managers, we have a particular deviation away from for that particular category, we need to see how much the particular portfolio manager is then going to deviate away from that estimation. So that's basically the three-step process. But the big picture is you try to estimate a normal return, and then you try to find out how much our future we expect to deviate away from that normal. Okay. The next concept we talk about is market timing. Okay, recently it's been referred to as dynamic asset allocation. What is that? Market timing is basically how well we can predict the market. If you think of it from a simple perspective, It's as if we're going to buy all our assets before they have big stock price positive returns, or sell all our assets before they have negative returns. So, for example, if we believe that a certain asset is going to increase in its value next week, we go ahead and buy that asset this week. Okay, so we're buying low, and then we've captured all those gains. Okay, and then let's say the following week we believe that that asset is going to drop. So today we expect that next week it's going to rise in price, and then 2 weeks from now it's going to drop in price. So a good market timer then would basically be able to buy the asset today, let the stock price rise, and then next week, before the stock price tanks in week 2, we sell all our assets. Okay, so that way we've bought low and we've sold high, and we've done a perfect sort of estimation of the market. Okay, so if you think about it from a bond perspective, okay, bond prices depend on expectations about future interest rates. Again, what the average estimates about everybody's, what the average estimate of everybody is going to be about how the future interest rates are going to move. Okay, so if we have a successful bond manager who can time the market, they not only have to forecast future interest rates. Okay, that's the first job that they got to do, is be able to forecast it well. But then, and they have to forecast it that's different from the outcomes from what everybody expects. Okay, they have to forecast something that's different from what the consensus forecast is. And then, not only do they have to forecast something that's different from what everybody else believes, but they also have to be more accurate in their forecast than in the consensus of those forecasts. Okay, so there's a lot of things that go into being able to be a successful market timer. And research shows that there's actually very little evidence that market managers can successfully time the market. Okay, even if managers were successful, it would actually take many years to determine that they actually were successful, because there'll be an error that comes in over time, and over a long period of time these errors sort of cancel out, and then we're able to actually estimate the true performance of that manager. Okay, so administrators usually do not have time to waste, and they do not want to wait years to decide if this manager is actually good or not at their job. So they'd rather keep it at target weights. Okay, they set target weights for their different asset classes, and then they allow just small deviations away from those target weights over time. So first, as we talked about, in order to estimate expected returns, we first need to determine what the normal returns are of those assets. Okay, so what is one simple way we could do to determine normal returns for an asset is we try to use the long-term historical performance of that asset. Okay, so we look at how it performed over a long term, and then try to use that to estimate what the future is going to do based on that. Okay, so there were actually these researchers, Ibbotson and Sinkfield, in 1976. They published these results where they collected data from 1926 onwards, and following them, more research has been done on these kinds of estimates, and published data about returns in a historical sense. Okay, so what is an equity premium now? What is an equity premium? We've covered this in all the finance classes so far, but basically the equity premium is the difference on returns expected for an investor between a risky asset and a riskless asset. Okay, so in this textbook, it talks about the difference between large company stock returns and the U.S. 30-day T-bill. Okay, so those returns are then going to be called the equity premium. Okay, so investors could hold a riskless asset such as the 30-day T-bill, or they could invest in risky assets. And the amount of extra return that an investor needs to get in order to be able to hold a risky asset is then called the equity premium. Okay, so basically, what is the idea behind this? So it's generally believed that if you can estimate one asset category with relative accuracy, then pricing other assets relative to the one that you can estimate accurately is actually going to be a good way to forecast expected returns. So if you think about how can we find certain assets that are easy to forecast. If you think about a 1-year T-bill, okay, the expected 1-year return on a 1-year T-bill is its yield to maturity. Okay, so it's a short period of time. We have the yield to maturity, and this can be observed in the market. Okay, and these can be accurately forecasted as well. So then we use that 1-year T-bill as the baseline from with which to forecast other assets' expected returns. Okay, so the 1-year T-bill then is a useful benchmark for building expected returns for other categories. Okay, the equity premium is then added to that current T-bill rate to form a forward-looking expected return for U.S. equities. Okay, so what is it going on? So if we want to find the expected 1-year return, we will just on that equity, we're gonna just add in what the 1-year return is on the T-bill relative to that. Okay, so remember, the yield to maturity is the expected 1-year return on a 1-year T-bill. We found an annual equity premium of about 8.29% between 1926 and 2011. So if this is the equity premium, and we have some rate for the 1-year return on a T-bill, we could then find out what the forecast is for equities in the future. Okay, so the equity premium is added to that current T-bill rate to form a forward-looking expected return for U.S. equities. Okay, so if we have, let's say, a 3% return on the T-bill, let's assume a 3% return on that T-bill, we have 8.29% equity premium, then we'd expect that the U.S. equities are going to perform as 8.29% plus 3%, okay, which is 11.29 is what we expect in the future. So now this positive equity premium, is that just a passing trend or has it been established for a long time? So research has also been done in an international context. Okay, they've examined the same results over multiple countries and found that regardless of which countries you do and regardless of which baseline you use, such as government bonds, bills, or inflation, this positive equity premium is a given. Okay, that's the rule rather than the exception. It's always an estimate. So if there always be an extra return demanded for holding a risky asset than a riskless asset, and this holds even considering all these crashes that we had in different years. Okay, right from the Great Depression crash, we've had the tech bubble crash, the 2008 financial crash. Equities have still provided a long-term positive premium. Okay, that means that there's always an increase in return demanded by investors to hold equities rather than riskless assets. So in the next video, we're going to go into Bayesian estimation, and we'll pick up there.